Hello friends, welcome back. So now today we are going to discuss about investment accounting. So if you remember, in the previous session we talked about the accounting of receivables, inventory, and now we are into investment accounting. Actually, what is investment? Investment means if your company have some investment or some holding in another entity, that what we called as investment. So there are various type of investments are there. So in this lesson, we are going to deeply into investment accounting, how we are treating different investment, how we are recording or reflecting these investment in our books of accounts. Suppose there is a case, if a company purchased a 500,000 in corporate bond from a tech supplier to earn interest on its idle cash. If a company has some idle cash, it's invested a 500,000 in a company with operating in a different sector. This is an investment. So the intent to invest is to earn an interest or earn an return for the idle cash. The other investment scenario, let's move into another next investment scenario. A company acquired 35% of common stock of a logistic partner to secure better distribution right. This is another type of investment. So while we are accounting this investment, the different for this type of different investment have different treatment. We cannot treat all the type of investment, all the category of investment in the same way. So there are different methods to account this investment. So today we will dive deeply into investment accounting. So there are some categories of investments are there. The passive investment. Passive investment means we have some excess money or idle money where by using that you want to earn some return. That is passive investment. So the treatment of passive investment is different from the other influential partnership or full acquisition. So these classification decide whether the company look more profitable or more leveraged to investors. So you have to classify these categories of investment in appropriate manner, then only the investors or the decision makers can look into this investment and make various decisions. The investment accounting is governed by the level of influence or control an investor has over its investee. It's just about ownership of shares, it's about economic reality of that relationship. Before accounting or before treating an investment, you have to consider what is the economic reality of that investment, what is the real motive to make that investment. The correct classification ensure that financial statement accurately reflect the risk and reward the company exposed through its holdings. The accurate classification of the investment ensure that the appropriate reflection of risk and reward that company has to expect from the investment. So let's move into some thinking. If a company owns 25% of a company's but no seat on the board of directors, do we really have significant influence? The simple answer is no, because if the company owns 25% of the ownership, mean the rest 75% still doesn't have any control and it doesn't have any seat on the board of directors, which means it doesn't have a proper control over the decision making process. So is this a significant real influence? Actually it is no, there is no significant real influence in this case. The second case, why would a CFO prefer to classify debt as hold to maturity rather than trading during a period of high market volatility? If you are classifying your debt into trading, mean you have to reflect your day-to-day or periodic profit and loss account or value loss or value increase in your profit and loss account. But if you are classifying as held to maturity, which means you don't want to reflect all these into your profit and loss account, you will report these only into other comprehensive income or statement of other comprehensive income. If we own 60% of a subsidiary, why it is misleading to only report our share of their profit rather than consolidating their entire revenue? This is another type of investment. In this case, you have a significant influence over your subsidiary. So in this case, you have to report or you have to prepare a consolidated financial statement rather than showing the investment value in the assets. Why you have to do that? Because you have a significant influence there in that company, in the subsidiary, over its various decision making, investment decision, and any other type of strategic decision making process. So in this case, you can consider this as a branch, or you can consolidate, you can prepare a consolidated statement by considering that as your own branch. So let's move into classification of the instruments. So first we will move into debt securities. What is debt security? You will learn you are giving a debt or to a company to run their business, and you are buying some debt instrument like bond, note. These are some debt instruments. So if you have own debt instrument, these are the cases that applying for you. First thing, you bought debt instrument for trading and make short term profit. You have to report that at a fair value. Changes go to net income. This is the debt instrument treatment while you are purchased it for trading. Then the available for sale of security. This is another category of debt instrument. So you purchase it to hold, but it's available for sale at any time. So in this category, you don't want to reflect your changes in the market price in the income statement. Why? This will bypass the income statement, and these changes in the market value will reflect only in the other comprehensive income statement, not in the income statement. Then held to maturity. What is held to maturity? If you bought a debt instrument, it's have a maturity period of 5 years, that is held to maturity. The management has intent and ability to hold until end. So this security you bought to hold until its maturity period, it's reported as amortized cost. So these are some classification of debt investments. So first category is trading. That means you reported at fair value, fair market value. Changes go to, is there any changes in the fair value which will reflect in the net income. Then the available for sale of securities, which you bought for holding, but it's available in all time to sell. So which will reflect in the other comprehensive income, not in the income statements. So then the held to maturity. Held to maturity means you held and you have ability to hold until the end or the maturity period. This is reported as amortized cost. So in the same way, let's move into equity securities or stock. Here also you can see the three categories of classification. First one is passive income. What is passive income? Passive income when you have some passive money or passive liquid money in your bank account. So you bought some investment to earn that passive income. That means if your ownership is less than 20%, there you are classifying as passive income. There is no significant influence in this case. It's measured at a fair value through net income. Then the significant influence. Significant influence means it is the ownership percentage between 20 to 50%. If you own equity of a company between 20 to 50%, you have a significant influence category. Here the treatment is different. You record your share of their earning as an increase to your investment account. If this subsidiary earns some money or profit, that you can record as a increase to your investment account. So here you are classifying as a fair value, your investment value in the fair value. So in the significant influence case, you can record if the company earned, your subsidiary earned suppose 1 million profit and your ownership is 20%. In this case, you can record 200,000 as your investment account or investment appreciation. Then the third category is control. In this category, you have proper control over the company, over the subsidiary. That means you have more than 50% of ownership. In this case, you can use consolidation. That means both entity, your entity and your your subsidiary entity considered as a single entity, and you have to prepare a consolidated income statement, and you have to treat this as a single economic unit. So, these are the some treatment for equity method, equity securities. So, let us move into some examples. Consider this scenario: a firm investment 100,000 in marketable equity security. By year end, the market drops to 92,000. Under the US GAAP, if the firm doesn't sold the shares, it might recognize 80,000 as unrealized loss in the income statement. It is directly reducing the earning per share. So, this is a less than 20% ownership case. If you have any loss or the market price drops by 88,000, you have to consider this as a direct loss, and you have to reflect that in your income statement, and which will directly impact your earning per share also. So, let us move into second scenario. A firm buy 30% of Alpha Service for 3 million. Alpha earned 1 million net income and pay 200,000 total dividend. In this case, you can record 300,000 as your investment income. That means 1 million, this 1 million you earn as net income, and you already own 30% of their ownership. That means you can consider 300,000 as your investment income. Again, the dividend, they paid total 200,000 dividend. So, your portion of dividend is 60,000, is not the net income. It is not the income, it is the return of investment that reduce the asset carrying value in your balance sheet. So, in this case, this is the equity treatment. In the equity treatment, what your subsidiary or what the company earns, that you can, your portion of that you can consider as a investment income, and what you receive as dividend, that has to be reduced from your investment amount, because you already considered that as equity method. So, which means you have a significant control there. So, what dividend you have received, that has to be reduced from your investment account. So, this is the first treatment. There is no significant ownership in this case, which is less than 20%. This is the equity method, which means you have control over 20%. So, just a classification and measurement rule as a summary. If you have investment in debt for trading, it is your intent to ownership is to make short term profit. What is the valuation method? It is fair value. And is there any unrealized gain and loss? You have to reflect in the income statement, net income. Then when it comes to debt security, the available for sale, that means it's mainly the strategic and liquidity purpose. Valuation, it is fair value, but the debt available for sale security, it is reflecting in the other comprehensive income, not directly in the income statement. Here just need a clarification. If you sold that quantity or sold that security, it will directly affect in the income statement. If we are still holding that security, in this case you have to, the price valuation or the price variation you have to reflect in the other comprehensive income statement. Then the equity, if it is the ownership percentage is less than 20%, you have to value the fair value, and the fluctuation in the market value is affecting in the net income. Then the equity, if you have significant influence, that means your ownership is between 20 to 50%. In this case, you can use equity method. In this case, it is the unrealized gain and losses you are not going to reflect. In this case, if the subsidiary company earns any income, so your portion of that income you can consider as an investment income. At the same time, if the subsidiary company pays any dividend, that value you have to reduce from your investment value. Then the next category, the equity control method, that means you have ownership percentage of more than 50%. So, in this case you have to consider as a consolidation, and you have to prepare a consolidated statement even you are not owning 100% of that company. That means you have to prepare the combined financial statement in this case. So, while you are preparing the consolidated financial statement, suppose your investment side will show, suppose you own 60%, that 60% value will show in the balance sheet, it will shown in the debit side, that 40% you have to reduce at what you called uncontrolled ownership. So, in this way you have to report all your asset in your balance sheet and the balance 40% you can reduce as uncontrolled interest. So, the net impact will be 60% will be net impact in your balance sheet. That means you report 100% here of asset here in your asset side, and in the liability side you will report 40% as uncontrolled ownership or uncontrolled interest. So, your ownership percentage 60% will exactly will reflect in the balance sheet as asset side. So, here some critical exam points. Under the equity method, dividend received are not revenue, they are liquidation of your investment. If you are treating as equity method, if you received some dividend from your company, from your subsidiary company, that is not considered as a revenue, that you have to reduce from your investment value. That means you have to debit cash and credit your investment value, investment account. Then the consolidation principle, when you are consolidating, 100% of your subsidiary asset and liabilities are added to your parent's balance sheet. Even if you are own only 60%, the rest 40% don't own, is reported as a non-controlling interest in their equity section. So, in the asset side you have to consider only 100% of your subsidiary assets. In the liability side also you have to consider 100% of the liability. Then the 40% what you have to consider, reduce 40% as non-controlling interest in your equity section. So, the net impact will be 60% of asset what you own. So, just a quick summary what we discussed today. The intent matter, while you are classifying debt, the intent matter, whether it is trading or held to maturity, depending on what management plan, based on that the treatment will matter, treatment will change. Then when it comes to equity, the 20% is a magic number. If your ownership percentage is below 20%, that means you are considering as a passive investment and you have to reflect your changes in the market value in the income statement. Then if you are own between 20 to 50%, which means you have a significant control over that company. So, in this case you have to reflect the subsidiary company's earning as your investment income. Then the consolidation method, that means if you have more than 50% ownership in your subsidiary or in another company, that means you have to prepare a consolidated statement. That means you have to consolidate these two companies and you have to prepare a consolidated financial statement as a investment treatment. So, let us move into multiple choice question practice. On January 1st, year 1, Zecos purchased 25% of common stock of Anchor Incorporation for 500,000. During year 1, Anchor reported net income of 120,000 and paid total cash dividend 40,000. At what amount should Zcorp report the investment in Anchor on December 31st, year 1 balance sheet? So, here the total stock purchase for 500,000 and there is a net income of 120,000 and there is a dividend received of 40,000 and you have 25% of ownership. So, how you will calculate your total investment value? First thing, you have to take the full investment value, that is 500,000 plus you have received a net income of 120,000. So, this net income you have to affect. So, the 25% of this 120,000 you can consider as your investment income. So, this is 30,000. 30,000 means 25% of 120,000. Then you have received a 40% dividend, 40,000 dividend. So, this you have to reduce from your investment value, that means 10,000. Why you have to reduce? Because you have received that dividend, that is a contract to your investment. It is 520,000. So option B is the right answer here. It is 520,000. So let's move into question number 2. Which of the following investment classification required unrealized holding gains and losses to be reported on other comprehensive income rather than net income? So here which of the following investment classification required unrealized holding gains and losses reported other comprehensive income rather than net income? Then the equity security with less than 20% ownership, debt classifying as trading, debt classified as available for sale, debt security classified as held to maturity. So which of these you have to report as unrealized other comprehensive income rather than net income? So which one? The debt classification, debt securities for available for sale of security, that we have to classify as that impact or the changes in that security you have to impact in the other comprehensive income. So option C is the right answer here. So this is about today's discussion. If you have any doubt or you need any clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.